Participant education. Investing. Deciding which asset classes to invest in, or your asset allocation, is the third factor you have control over in preparing for your retirement. When deciding where to invest your money, it's important to consider a number of factors like your age, how long until you retire, or your time horizon, how comfortable you are with risk, any large investments or expenses you have coming up in the next few months or years. The more you match up your time horizon, goals, and comfort with risk with your actual investments, the more likely you are to achieve your goals. If you feel your investments are too risky, you may decide to pull those investments at the worst possible time, near a market bottom, and cement in your loss. A common misconception for individuals approaching retirement is that they should start investing very conservatively. But with rising life expectancies, retirees can live 30 years into retirement. Keeping money only in conservative investments reduces the beneficial effect that good rates of return and compounding can have on long-term savings. The bucket strategy displayed here is a way to plan for the different goals you may have at different stages in life. How far out your goals are, or the time horizon, commonly affects the type of investments you would choose to achieve those goals. Understand your investment time horizon, since your investments will rise and fall in value throughout the time you own them. The longer your time frame, the greater your ability to ride out the ups and downs of the markets. Typically, the idea is that monies or expenses needed in the short term, for example, the next few months to a year or two, should be invested fairly conservatively, while investments with a longer time horizon, like over 10 years, can be invested in a higher proportion of equities or stocks. Experiencing market volatility in retirement may result in wanting to sell at the wrong time or not having enough equity exposure to keep pace with inflation. Thinking about a retirement portfolio in time-segmented buckets can help individuals maintain a disciplined investment strategy throughout retirement with an appropriate level of upside exposure to continue growing the overall account. For instance, let's say you have 3 goals you'd like to start planning for. The first is a year from now to purchase a new car. The second is in 5 years to help fund a child's college education. And the third is planning for retirement in 30 years. While this is a simplified example, each goal has a very different time frame and a different amount of allowable risk. The bucket strategy would suggest investing in cash alternatives, or short-term bonds to fund buying the car in a year, or your short-term needs, in a mix of equities and bonds to plan for a child's college, or your medium-term portfolio, and in alternative assets, equities with higher risk and a smaller percentage of bonds to maximize growth potential over the long term, like planning for your retirement. Since the expected time until each goal is completely different, the types of asset classes you should invest in generally will be different as well. Diversification refers to investing in numerous types of asset classes with the same total amount of money. By diversifying across asset classes, investors try to gain higher returns while still having a similar amount of risk to their portfolios. In the 2 examples here, we have a portfolio for the same person. On the left, this person might choose to have 10% invested in equities, 50% invested in the S&P 500, and the remaining 30% in fixed income assets like bonds. The total return the individual might get in this scenario is 5.4%, while the standard deviation, or risk, to their portfolio is 12.5%. In the graph to the right, this same person might have diversified into additional types of assets like REITs and emerging markets debt, increasing exposure to new assets that may have better performance. In this case, the total portfolio had a 6.2% return with a risk of 12.7%, just 0.2% higher risk for a 0.8% higher return. This 0.8% difference may not seem like much at first glance, but in your retirement account with significant dollars and over time, that 0.8% increase could grow to be a significant amount of money. So to summarize, diversification may provide better returns with a similar risk. Now that we've covered time horizons and investing in different types of asset classes to spread out risk, let's talk about risk in more detail. Your comfort level with risk matters. If you feel the different types of asset classes you're invested in are too risky, normal market volatility, or tougher economic years may make you very uncomfortable to the point where you sell your investments and potentially miss out on a future market rally. On the other hand, if you don't feel you have enough risk, you may be disappointed if your account is not growing as much or as fast as you'd like. In general, there is a trade-off between risk and expected return, as shown in the graph here. Investors who are not comfortable with risk, who expect there to be difficult market years ahead, or who are approaching retirement, tend to select more conservative strategies that lower the expected return but also lower the risk to their investments. On the opposite end, some investors are primarily concerned with growing their account sizes and are more comfortable with increased risk in order to have an expected higher return. These investors generally go for growth strategies and are often on the longer time horizon we discussed a few slides ago, like planning for a retirement 15 years out. Some investors are in the middle. They want some increased risk exposure to get an expected higher return, but they don't want their account to have too much risk. For this type of investor, they often adopt a balanced type of investing strategy. With investing, there are no guarantees on expected returns, so investors should be very careful that they are comfortable with the amount of risk given their age, income, family situation, health, etc. when selecting an investment strategy. It's important for investors to feel comfortable with their selected objective over time during favorable and unfavorable market periods. Selecting a plan you're comfortable with that takes into account your goals, risk aversion or tolerance, and your time until retirement is very important. There are a few investment options offered by your company's 401k plan that you can choose from. Many investors choose to invest in a target date fund, which is a fund designed to become more conservative over time as the investor approaches retirement. The investor selects a fund based on the approximate year they plan to retire. For example, a 2050 target date fund would be appropriate for someone approximately age 30 planning to retire in 2050. In addition to the target date fund, you also have the option of selecting CNR Inc.'s model portfolios or build your own portfolio selecting individual mutual funds. Thank you for watching our education program videos for 401k participants. Our goal is to provide you with enough information to help you make the best choice for you given your personal situation and goals. Ultimately, the choice is yours to make. We are here to answer any questions along the way. Please feel welcome to contact us at 818-340-0157, email us at info@crugg.com, or visit us at our website at www.charlesworthrug.com. Thank you.